Welcome back, everybody, to the Stock Market Brief Show. My name is Michael Silva. Today's September 14th, and we got ourselves a interesting show up ahead. If you're new here, we use technical analysis and intermarket analysis to get a good idea as to where market might be headed next. We're going to be discussing on today's show how the market responded to the macro data drops that came out and what's going to be on deck. We're going to subtly go over some signs that volatility is pointing out. We're going to hop into some intermarket assets such as the 10-year yield, the dollar, and oil. And then we're also going to take a peek and explore what the housing market is revealing about the broader trend in the S&P 500, all while keeping a close eye on the risk range derived from options implied volatility. So fasten your seatbelts, people. Let's get into it. All right, people, welcome back to the show. So yes, we got the PPI out and retail sales. PPI came in hotter than expected. It came in at 0.7% up month over month versus the consensus 0.4%. And then retail sales also went up. Now, how did the markets respond to this? You would think that a higher inflation could be potentially bad for the markets because it forces the Fed's hand to have to raise rates. But the September rate hike, unless if the Fed comes out and surprises us all, which they might, but the market's basically pricing it out. But it's going to be important next week when he comes out to see what the future guidance is going to be for the next rate hike, obviously. Now, the 11 sectors that make up the S&P 500 were all in the green today. Utilities was one of the leaders up here, and this is more of a risk-off asset. To see this up at the top, and then you see something like technology down there towards the bottom, which is a risk-on asset, it is a very interesting dynamic for the markets that are kind of throwing a couple of red flags, and we'll discuss that. If you take a look at the heat map, a couple ones that stand out was Netflix was down 2.85%. Clearly didn't have the market cap to really move the market. And then we had Visa down here, down 2.55%. And then the other big market cap names over here, NVIDIA, Microsoft, Google, all up on the day. Amazon was slightly down to flat, and Meta was up 2%. So if you take a look at the market net flow, we'll pay attention to this green line. So what do you notice here with the green line? It's basically just going up. So despite the macro data, despite the ECB raising rates, right, despite all of that, the call flow, so the market flow was positive for the majority of the day. You take a look down here, convergence was green too as well. And you saw puts kind of going down. You saw this subtle spike. I don't pay attention to these spikes. But what you notice here is just positive flow for the overall market, which is why, we were all in the green. It was just very simple explanation, right? If you take a look at volatility, what is it telling us? Well, it's getting crushed, and there's a couple levels here that I want to pay attention to. So 15, 14, 13, 12. Okay, so 12. It's right around 12. If you see these gray boxes going across my screen, so this was back in early 2020, and then over here in May-ish to June-ish, we filled that gap. And gaps in the VIX, they typically get closed over time. Now, what's crazy is there's actually one right at around 45 dating way back over in this range somewhere on the hourly time frame for the VIX. And I'm still thinking that might be one to get filled in the future. We'll see. But beneath us, there is still one at around VIX 12. And if we start closing down here, so if we get a push higher in the markets and this comes down even further, this is on deck. So this would be an important level to watch for the volatility index. Remember now, typically when you get a huge spike in the VIX, that's when you want to typically look to add because it potentially put pressure on the market to the downside. And then over time, the VIX, goes down. And when it starts getting, strong moves to the downside, you might want to look to take some profits. It just depends on your strategy and how you approach the markets. Now, if I take a look at this, what is volatility telling us? Well, this right here, this yellow line is actually looking at back month volatility versus front month. So it's just VXV over VIX. And when it's up here at this level, which says 1.2, which would mean that back month volatility, 3-month volatility, is about 20% above VIX, right? Of just the volatility index, VIX. Now, what I've noticed here, which I'm pointing out, is there's times where it reaches up to these extended levels. Boom, and the previous time it was just right here, just a little bit ago. It can mark turning points in the market. So you can see we reached this high level here and the market started to roll over. If I brought up a longer term chart, this happened a lot in 2022. And then we started to get choppier up in here where it kind of kept the market sideways. You can see we got another spike over here, a bigger spike over here, market down, and then really right here was almost on just the point right there going into September, and it started coming down. So we're not quite there yet, but we're getting into that area saying that, hey, if the market pushes up a little bit higher, just be aware that back month might be spiking. It can always spike higher, but it could potentially mark, part where we continue to consolidate, which is all we've been doing, or start to turn around. Now, if I take a look at the 5, 10, 20 timer over here, we did burst up. We talked about that yesterday, how it was contracting tightly. Overall, when I'm looking at this chart, we still have that downsloping trend that is yet to be broken as it stands. And now if I apply the weekly expected moves, ding, 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 we came in approximately around $2 away from it on the SPX, just about touching it as we got back above it, which was expected this month. Remember, the options expected moves, these are based off of implied volatility. These are not just levels that I draw out on the screen. This is a risk range. It's future looking. It is a leading indicator of potential risk up ahead. So that's always a good thing to at least put on your charts from a weekly perspective, or even daily if you like to use, just to see what the options market is pricing as far as risk. If I take a look at the weekly time frame, you can see here we are still consolidating. So we have one big candle, another pretty big authoritative candle, and then a decent candle. But what you'll notice here is that is contracting. You have a high, a low, a higher low, a lower high, and then a lower high, and then a higher low. So what we're doing is consolidating. We are contracting. So which way is this going to break? I don't know. We came up into here, which is a prior area of resistance after it was once support. And as it stands now, this could be just consolidating for a break through that 45.27. Or if we start breaking down through the low of this weekly candle, be on guard because we could come strike lower. And the same thing goes for the Qs as well. Right? This is the third week of consolidation. No idea if it's going to break to the upside or downside, but be aware if it starts breaking down through 372 or if it starts breaking up through, well, as it stands right now, breaking up through the prior week or through this week, but breaking up if we close within here, or if we don't break the high of this, it'd be just above 378 would be the level to watch on the following week. Now, if I take a look at oil is continuing to chug higher, right? And we talked about this on a prior video. It was this video of why it's important to watch oil's move, especially next to the 10-year yield, right? So the 10-year yield today, we gapped down, but then we finished higher, which is actually a bullish sign. So still consolidating sideways. Yesterday, it was a bearish outside candle. Now we have a bullish piercing type candle. So it's just sideways price action. The bearish engulfing outside day is still actually active. If it would be negated if we start breaking the high from it. And now the bullish pattern would be negated if we start taking out the low of this one, which is at 42.2. So consolidation, but now we have some important levels to watch, 4.22 or 4.34 for the breaks in the 10-year yield. If we continue on, take a look at the dollar. This was consolidating, flagging as we discussed, and this thing broke higher. So a very interesting day, right? You get hotter than expected inflation data. The markets are responding accurately, but the U.S. equity markets are not, right? So, and the bond markets are typically the smart money, right? So the 10-year yield was up on the day. The risky, potential risk-off type asset of move to dollars was up on the day, and then the overall stock market was up on the day. However, when you look at the stock market and you break down into the sectors, well, utilities led the way there, so that outperformed the S&P 500. So overall, the markets were up, right? But there are some red flags as previously discussed. Now, why could this be? Well, we discussed the flow, the market flow. Okay, but then also we've been talking about seasonality, how you typically get a run up into the middle to end of the month, or the middle to late stages of the month, and then you typically sell off. But this is just seasonality. It doesn't mean it has to happen, although it's been fairly accurate so far. So tomorrow we're going into the 10th trading day. So it still shows that we potentially have that upwards momentum going into the remainder of this week. And if I take a look at the market DEX, this one is still more of a bearish tilt to the markets. This is the daily sum of deltas across the options flow through the entire market. Okay, so still have a bullish kind of headwind right there. Now I want to hop into this because this is incredibly interesting. This is the Dow Jones U.S. Home Construction Index. And as you know, you might not know, but this is known as a head and shoulders pattern. They could be potential topping patterns, where if you break down, have a closing day underneath it, and you stay underneath it, a measured move would take us to around that 200-day moving average. Why am I talking about the housing index? Is because the housing index has always been known to be a leading indicator for the S&P 500. Believe it or not, I can show you. So take a look here. Up top is the housing index, HGX, and then below us is the SPX. So this is just dating to 2022. And what you notice here is we have matching highs, but the stock market went higher. And that right there, the housing market didn't confirm, and we started to head lower. We had a big bounce, right, in 2022, but actually housing wasn't matching that bounce. So it got faded. The same thing here. And then on the flip side, heading into October, take a look at the housing index, how we put in a low and a higher low. And if you just look beneath us, you have the S&P 500 putting in a low, but a lower low. So housing wasn't confirming this lower low in the S&P 500, creating a positive divergence. And then the market started to run away, and we haven't really seen a divergence since. Now, why I'm pointing this out is because the market looks pretty healthy here. And if it starts breaking up higher, like so, look at what the current housing market is doing. It's currently, or the HGX, it's sitting on that kind of head and shoulders type pattern, and it might not confirm as we're below a 20-period moving average that could very well start to curl over. So if I pull up the Dow Jones U.S. Home Construction Index, you can see the 50-period moving average. It broke down right here. It held as resistance and resistance again, and we're kind of seeing a declining 20-day. So the longer we stay within this range, this is going to start curling over, which could tell us that the trend is changing to break down, and that could be giving us some insight early on to a potential break in the S&P 500. Now, you might be thinking that's crazy. Well, you can also date this back multiple times throughout history. This is actually one of the best indicators that was leading into the financial crisis. Housing market actually topped in 2005 after a monster run-up, and the S&P 500 was going up high too. But then we started to break down and then create what's known as a lower high. But what was the S&P 500 doing? The S&P 500 rallied, and we saw this blow-off move into around October 2007. And what you'll see here is if I just draw the lines, you have clearly a divergence that was taking place. And then what did that lead to? It led to a monster move to the downside, obviously, in the market. So the housing market led us, kind of gave us that insight ahead of time. And is this as big of a divergence? No, this is not as big as a divergence. These are smaller divergences. So the bigger that they are, they could potentially be stronger. Just like this one was a pretty strong divergence. It was multi-months. This one would be just a few weeks to a few months. Okay, let's continue on and take a look at the smaller dynamics of the S&P 500. We'll look at the 15-minute time frame. And we talked about the upside down UFO pattern over here. Well, we broke out, we pulled back a little bit, and we started ripping above the daily expected move. And you can see here on the pullback, if you apply anchored VWAP, it held as a level of support throughout the day, almost tagging the upper weekly expected move. So if you're ready to catch that, congratulations. I definitely played that move today. If we take a look at the updated daily expected moves, where we stand overall, I removed the little channel here just to clear it up, just to clean it up a little bit. But if we start seeing the market pull back, understand now that we're above all those levels of confluence. Now they're just kind of neutral and trending, sideways. That's what I mean by neutral. But the 5-day moving average is starting to curl up, which is a positive sign. So if the market were to sell off, we have the lower daily expected move at 447.61. That'd be in confluence with the week to date, month to date, quarter to date, 5-day moving average, and the daily expected move, which could be a very good opportunity if you miss this run up. And if people aren't watching and paying attention to this, and this just drops, they're like, oh, it's game over. But these are some key levels where, hey, if we comes in, and even a gap fill down here too, could be an opportunity, right, to potentially play a higher move going forward. Now, if this low is starting to get taken out, then obviously we have to be more cautious. On this breakout or on this pullback, I think I entered right around this range right here. So it pulled back. I didn't just buy the pullback. I waited for strength to show up. I think it was right around here, and I played it up. Okay, if the low of today is taken out, Watch for the gap fill. Watch for this area of confluence. The big levels to watch, obviously, would be if we start taking out the week-to-date low, which is right here, okay? And that would be a little bit more cause for concern, but it's not there as it stands. So potentially, if it does take place tomorrow, then we'll watch out. But going into the following week, then we'd be paying more attention to this level as well. If I take a look at Bookmap, what do we got? Not much. I just wanted to point out that that 48.50 level is still there. And if you want the updated daily expected move, something that I share with my Patreon group, Discord group every day, you can take a screenshot of this. This is SPX, ES, NQ, Ruddy, SPY, Qs, and IWM. You got your upper levels, lower levels, and then I included the 2 Sigma levels there too as well. That's all I got for you on today's episode, everybody. See you later.